Hello, welcome back, everybody. Good to see so many people here back in the room and coming off of a very interesting and provocative conversation between Perry and Claudio Borio just finished up about half an hour ago. We are taking the day in a slightly different direction now, obviously related for those of us who follow these things closely, but looking into this financial world from a different angle. The subject of the next session is DeFi, broadly speaking. Grew out of a conversation, grew out of lots of conversations that many of us have been part of. Most recently, Larissa and I met a few weeks ago now and started, had a wide-ranging conversation about what we should say about DeFi, started to try to pull together some names, and Larissa, in fact, had something, so became a presenter. I have things to say about this, but I'm going to save them for my session tomorrow, which I hope you all come to. And we reached out to Sébastien and Raphaele, who both responded positively, and we've ended up with this session. This is a money view event, so we're looking into the DeFi world, but we're trying to add something to our understanding of decentralized finance, crypto more generally, by being very serious about using the money view. And if I had to go out on a limb, I would say the big implication of that is that, generally speaking, everyone here is curious enough about DeFi to want to study it, but we also think that for the most part, what we're talking about is financial functions that already exist. So we're trying to understand these new financial ideas using techniques that we already have that work pretty well for the existing bank-based financial system, and trying to figure out what adaptations and what genuinely new things we need to understand. And so we called it 3 money views of crypto, also to signal that the money view is, we can all get together and have a weekend about the money view, but also there's plenty of flexibility and different approaches within the money view, and the 3 points of view here are different from each other. I think we have the material for a good conversation, but we're not all saying the same thing either. So that's enough for me. We'll have 3 speakers. We are planning on about 15 minutes a piece, and then we'll go into questions. I'll just say now, everyone here wants there to be wants to have good questions and good responses, good interaction. I will ask you, as you try to formulate your questions, it would be great if we could have questions that speak to more than one of these presentations. So can I ask you to listen hard, listen carefully, and try to come up with questions that could speak in different ways to more than one of our speakers? And I feel like that would be a good input to a nice conversation afterwards. All of these questions are not going to end. You know, this conversation about DeFi and the money view is not going to end in the next hour and 15 minutes. And so we would also like to find ways to continue this conversation afterwards, as we are continuing it now from things that have happened in the past. So with that, I will introduce our first speaker, Raphaele Chappe, an economist who wears a number of hats, described on the program as coming from the DeVol network, and is going to get into Uniswap with us, market making in the DeFi space, and a little bit of a spoiler, I should say, that Raphaele has a trainer diagram in her slides. So we're big fans of trainer here, and you can look forward to that. Raphaele, please.
Thank you, Dan. Hi, everyone. I'm also hoping that not only will this not be the end of the conversation, but really just the beginning. So I'm here to present about a new form of market making, the so-called AMMs, automated market makers. And that should really be of interest to this community, right? We're really interested in the role of dealers. And so here's a new way of market making in the DeFi space that's interesting. So first, I'll just try to give you a sense of what these things are and how they work, and then we'll go into the trainer model. And then finally, if we have time, we'll look at some controversy on the profitability of providing liquidity via these AMMs, and particularly in the case of Uniswap V3. So first, to give you a little bit of an overview, these AMMs are part of the nascent DeFi ecosystem, and they're algorithmic agents that provide liquidity and they're particularly being used with DEXs, right, decentralized exchanges, to facilitate trades. The space is primarily non-custodian, right? So you don't have a centralized intermediary. And there are different kind of market maker where it relies on liquidity pools to make a market. And the liquidity pool is a collection of digital assets that are locked in a smart contract with liquidity providers, that's the terminology, providing these assets to the pool. And so there's no need to match counterparties in order to have a trade. The pool itself is the counterpart. The other interesting feature is that the price is determined by a formula which is deterministic. So it's a very different way of making a market. So specifically with Uniswap, the most, I would say, famous and successful of them all, it's a so-called constant product AMM. It's used for spot trading. And the formula here is that the product of the reserves of two assets has to be equal to a constant. It's one of the biggest DeFi projects on Ethereum. You can see here 3.7 billion of TVL, total value locked. But it was even higher a year ago. And so let's look at the mechanism of how this works. So you have a liquidity provider that puts in these two tokens in a very specific ratio, puts them into the pool, and in exchange gets a token, which is a claim on the pool. And a trader, this is the graph in the middle, that is looking, for example, to sell, let's say, token X, this could be Bitcoin, is going to put some amount of Bitcoin into the pool and is going to withdraw some amount of token Y, which could be a stable coin like a USDC. And so there's a delta X and delta Y less some trading fees. And similarly, if you were looking to buy some Bitcoin, you would do the reverse. And the proportions are determined by the pricing algorithm. Here's an example of what these pools look like. If you were to get on the website on Uniswap, you would see different pools with different pairs. And you would see right next to it, see the 0.01% or 0.05%. That's the trading fee that's associated with the pool. The pricing, there's a lot of math on this slide, but you don't need to let that distract you too much. Really, the idea here is that if you start with the formula that the product is a constant, you can manipulate the expression and you can see that the price, delta Y divided by delta X, is a function of the size of the order that's being placed relative to the reserves of that particular token. That's the first component. And it's also a function of the relative size of the pools, which is something which is fixed, right? Which a trader has no control over. So that's the price impact of a trade. And then on the right, you can see with this diagram kind of an indifference curve, looking at the quantity of the reserves in the pool. And you can see that, this is economics. So the slope is the marginal price. The reserves of tokens are constantly rebalancing after each trade. So the price is constantly moving and the tokens get exponentially more expensive, right? As the reserves get smaller. And so in theory, you can't remove liquidity completely, as long as the LPs don't withdraw from the pool. It's just that the tokens get increasingly more expensive if there's pressure on a particular token. I want to talk about a little bit this concept of price discovery on-chain versus off-chain. So this is on-chain, right? And most of the flow, it would appear, actually comes from arbitrage that are moving the price in line with the value of these tokens on centralized exchanges. So it's lagging behind a little bit. And the reason for this is the block time, which takes longer than on a centralized exchange. And also the gas fees, which make it expensive to place an order or cancel it, right? So there's some friction there. So it's mostly arbitrage that's aligning the prices with centralized exchanges. And that can result in some negative selection, which is called toxic flow, is the language being used, which could result in losses for LPs to the extent that the pool is buying or selling at a price which is slightly lagging behind the actual price. There are some benefits to on-chain price discovery, right? The idea that information is equally available to all market participants. The price is deterministic, so that's designed to minimize negative selection for liquidity takers. And if you think about the impact of large orders on price, it's dependent on the pools, as I showed you in the prior slide, rather than the volume of trades. So there's perhaps the potential to have less sensitivity as long as the pools are large. That's a big if. Even though there's no bid ask, right? There's no dealer that's posting a bid ask prices. You could still think of it a little bit in terms of a bid ask spread, because on top of the price that you're paying, if you're buying or selling, you have some gas fees, which is the cost of performing the transaction on the blockchain. That's network capture. And then you have some trading fees, right, which is the pool compensation, which is paid by traders. And then you also have an impact on the price, so price change resulting from trade. So all of these impacts are adding up on top of the price paid by traders. So let's look at the balance sheet approach. I think is interesting. This is the money view. We love balance sheets. How is this different from traditional market making? And from what I can tell, you do have a very different setup. With the traditional dealer system, each dealer has separate inventory and then a mix of debt and equity funding. But here, the pool itself is on chain. It has a number of assets, the different token pairs. That would be the inventory. There's no real credit or maturity transformation. The liabilities of the pool, it's really just literally the share held by the LPs. So it's completely flat. So I don't think you have in this balance sheet difference between market liquidity and funding liquidity, right? It's all really just one flat balance sheet, and critically, there's no equity to absorb anything. In terms of risk return, the LPs earn a share of the trading fees. So that's that's analogous to the bid-ask spread with the traditional dealer. And then in terms of risk of losses that they're exposed to, there's so-called impermanent loss, which is that the price of the deposited assets can change in the pool between the time that they're deposited and sometime into the future. And these price changes actually lead to losses for liquidity providers. And so the hope is that the trading fees make up for impermanent loss. I'll get to that in a second. So that's one source of risk for LPs. And then the other source of risk is the toxic flow, the negative selection from liquidity traders that could also result in losses for LPs. So here's an example of impermanent loss. We don't have to go through the numbers here, but I wanted to show you the idea. The idea here is not so much that the LPs are losing money, but rather that they would have made more money by holding tokens directly as opposed to putting them in the pool, to the extent that the relative price of tokens is changing. And the reason it's called impermanent is because the price can change, but then it can come back to its original level. So I'm showing you an example here with some initial prices, and an LP puts token in the pools and they add up to $200, and this person gets a 10% share of the pool. The prices change. You can satisfy yourself that the product remains a constant. There's now a different price ratio and different sizes of reserves in the pool. And now your 10% share of the pool, it's gone up, right? It's worth $282. But if you held the tokens directly, you would have ended up with $300. So more money. So that's impermanent loss, is the difference between the two. And there's a mathematical formula. You can visualize this, and you can see horizontal axis here is the price ratio You start at 1 and then it can go up or down, and there's a loss in both scenarios, right? But the loss is a little bit more severe when the price ratio goes down. And so if you use the prism of the trainer model here to sort of think about this new way of market making, you'll find that the same factors that influence the inside spread in the trainer model are present. In terms of the asset volatility, you don't have inventory risk, but you have impermanent loss. In terms of adverse selection, you don't have pick-off risk, but you have toxic flow. So you have the same sources of risk. The big difference here is that the LPs have no ability to adjust the inside spread. The price is deterministic. What you can do is just decide whether to put tokens in the pool or not, but anybody who puts token in the pool at the same time is subject to the same risk return profile. So one key differentiator potentially between LPs is the timing of the liquidity provisioning. And that could be the difference between active LPs versus passive LPs. And same thing with the outside spread. It's seemingly irrelevant to prices, but I think it could still influence the decision of LPs to invest in the pool and the timing of it. So to finish, I'd like to tell you a little bit about this interesting recent controversy around the profitability of LPs in this Uniswap V3 version. This V3 version, there's a slight tweak to it, which is that the LPs provide liquidity, but within a custom price range as opposed to the full price range. So you limit yourself to a specific price range. And that gives you greater capital efficiency because you can provide the same liquidity, but with less capital. And when the prices get outside this price range, the positions could get liquidated, in which case whatever impermanent loss is there would become permanent, or the LPs can leave the funds in and not realize this loss, but then they get no trading fees. And here's an interesting study that shows, so they analyzed the pools on V3, 17 pools that covered about 43% of the TVL, and they found that actually most pools are at a loss in that the trading fees don't cover the impermanent loss. So there's an estimate of this loss here, 60 million. The other thing that's interesting is that they looked at the profile of different LPs in terms of the length of time that they were active. And they found that the so-called flash LPs who provide liquidity just during one block. So they very quickly come in, put tokens in and out at strategic moments, the so-called just-in-time liquidity. You see them on the right that they have, they're earning fees, but no impermanent loss at all. So you have very sophisticated liquidity providers who are timing in order to not be exposed to impermanent loss. Another debate, and let me look at the clock. I think, yeah, I should finish. Other attempts to measure so-called toxic flow, and this is interesting controversy where people started measuring the so-called markout as a way of measuring toxic flow, right? Toxic flow is just the idea that someone out there is more sophisticated and knows something that you don't, but markout comes from high frequency trading and is basically pricing, assuming that the pool is offloading whatever position it took at a price which is just 5 minutes later or an hour later. And if you can show continued losses, then you have evidence for toxic flow, and this is the result here showed indeed some losses for LPs, and there's lots of things that could be said about this methodology, and I have some reservations, including how exactly the price is measured and whether you look at the price on the pool or should you be looking at the price on centralized exchanges. and different ways of measuring this. So I think there's an open debate as to whether this result is true, that most LPs would end up actually at a loss, but it's still interesting preliminary result to think about. And so I think the question raised here is that of achieving sustainable liquidity provisioning in DeFi. Is there an issue that liquidity is underpriced, so maybe the fees are too low? Is the issue that the fees are not dynamic, and that's a problem? Is the issue maybe deterministic pricing that has unintended consequences? I think there's lots of kind of open questions we can talk about. And the last question that I have is the volatility of the liquidity conditions. And do we find that liquidity is stable or not? And how does that compare with traditional markets? Okay, I'll stop here.
Thank you so much, Raphaele. Really important contributions to our understanding of liquidity in DeFi. We have lots of questions. So if you have a good question for Raphaele, write it down now. We're going to go through the presentations first and do questions at the end. Up next, we have Sébastien Derivaux, who we heard from this summer, thinking through some of the big money view crypto questions. Building on that work, Sébastien is going to give us a shorter version, but also something that digs in a little more specifically. The title gives it away a little bit. Repo in Crypto, a New Paradigm. Sébastien, please.
Thanks. Let me just retry. Oh. Let me just restart my PowerPoint that crashed, obviously, in the meantime. It should be that way, I guess. Okay, let's try again. Is that good for you?
Yeah.
We can see it, but maybe you can put it into slideshow mode.
Oh, yeah, okay, it's not. Okay. So yeah, as Dan said, I will discuss Repo in Crypto, a new paradigm. So I will put the Repo inside what I call the crypto banking system, which is it's quite similar to the shadow banking system, but I just kind of retry to use the previous work and try to see how it fits. And crypto, and it's just like, well, what is the financial system on top of crypto and why it is different or not than the traditional system or the shadow banking system. And in crypto, like in any financial systems, there is a maturity mismatch. Lenders want to lend very short term, and in crypto, very short term, it's 12 seconds, which is the time of one block. And the borrowers obviously want to borrow a bit longer, obviously. And there is also the same issue that liquidity is queuing. If you want to provide, I don't know, for instance, to follow up on the example of Raphaele, just-in-time liquidity for some coin on some platform, you might not have the coin, you might want to borrow them, and so you need a counterparty to borrow them from, and to be sure that there is always plenty of liquidity. So on the diagram below, you see an example in crypto of the securitization process, starting on the left from borrower and going to the right to the people that are lending. I will not go too much in details, but overall, what I try to formalize is more or less to have, based on the Zoltan Pozar, the shadow banking system, the crypto banking system, where you have the lenders on the right and the borrowers on the left, and the items or the entities that are inside this banking system. What is good in crypto is that we are super early, so there are less complicated stuff than in the original paper. But still, and we focus mainly, what is the core of the system is mainly what is in the middle, what I call the crypto markets, which are composed of the decentralized exchange that Raphaele spoke about just earlier, and the money market or the repo, which are really, as you can see, just in the middle of the picture. So that's quite appropriate to dig a little bit deeper on those ones. So what are the key principles of a crypto repo? Just like for Uniswap AMMs, liquidity is pooled. There is no or very little peer-to-peer protocols. You don't lend to someone. You put your assets in a pool and the borrower will borrow from this pool. So it's quite asynchronous. And so one consequence of this is that there is currently at least no maturity. It's always, or very little maturity. It's always more of the time open repo. You start to borrow and you repay at some point your loan, but there is no maturity in that way or a time where you need to repay or get liquidated. And then obviously to incentivize borrowers to repay at some point or not, we have something called the interest rate, which depends on the liquidity utilization. So there is a target rate that is fixed by the governance of the protocols, but the actual rate will be either below or above. And if the liquidation utilization, if all the liquidity used, usually it's a very high number because as you can see on the next item, liquidity is not guaranteed. If all the liquidity is drained and borrowed, you cannot exit the pool and you cannot get your liquidity back as a lender. So that's why usually the penalty interest rate is close to 100%. And obviously, another thing that is super important and different than the traditional system is that, well, you don't have a counterparty. You have the smart contract, but the smart contract doesn't, you cannot choose a smart contract. And the only way to get your cash back for sure is liquidation. And so the system is very open to be sure that anyone can liquidate someone that is not satisfying his haircut condition. And it's directly liquidated. We don't wait. Obviously, it's not a perfect system, but so far it's working quite well. Let's go now to an example of Compound V3, which is just a USDC protocol, or you can only borrow USDC on the V3. So you can see on the screen that there is 140 million deposited by lenders, and only 86 million borrowed by borrowers. And what does that mean as well is that you have two rates, and usually on most cases you have two rates. One for the people that are lending, which is in this case 1.9%, and one for the people that are borrowing, which is in this case 3.6%. The difference is that there is only 86 million that are yielding 3.6%, but there is 144 million lenders or volume of lending. So we'll see it gets prorated over this base. You have on the bottom the collateral that you can deposit to take the loan or to make the repo, which I use synonymously. The collateral list in this protocol is quite shorter than what you can have usually. That's a trend in repo to avoid the exotic asset because usually you fail due to exotic assets. It's usually mainly anyway Ether, ETH, and Bitcoin. And in this protocol, it's not rehypothecated, but in some other protocol, it can be that when you deposit collateral, someone else can borrow it. The rate depends on the utilization ratio. As we said, here in this case, the utilization ratio is at this time 60%. But what the protocol is designed for is that you are using it at what they call the king, the target utilization, which in this case should be 80%. And you can see that after the target utilization ratio, it's increasing quite sharply up to a penalty rate. Depending on each collateral, you can have a different haircut. So for instance, in this case, for ETH, you can borrow up to 83% of the value of the collateral. And if you have on less than 10% of a haircut, or if the value of the loan is more than 90% of the value of your collateral, you get liquidated and you will get a liquidation penalty of 5%. And obviously, what is super important in those cases is to have an oracle price, what we call an oracle, just a price feed, but with a better name. And those are given by an external actors, which is kind of decentralized, but it's not perfect because most of the manipulation is usually done with the Oracle price. So you can usually exploit those platforms due to the Oracle price. It's kind of something that people are working currently to remove the need for an Oracle price. So what are the issues and trend in crypto repo? It's quite interesting because last year it was, well, the institution will come into DeFi because the rates are so good on repo, and which is kind of the risk-free rate in DeFi. And now this year is quite uncompetitive because we are in a bear market. The main reason to do crypto repo is to leverage and get higher exposure on cryptocurrencies. But usually when the market is going down, no one wants to leverage. And now we have also the TradFi rates, which are SOFR or treasury bills and so on, which are going up. It's no longer 0%. You can see it on the chart below left. But now the TradFi rates that I use, SOFR, is way above what you can get by lending your capital on those repo market. There is also quite some work and quite some improvements that are working on currently to improve the system, to make it safer and so on. As I said, the reliance of external oracles and governance processes, people are working to remove those bottlenecks or those issues, because, well, you cannot say it's decentralized if you need to rely on governance that might or might not be decentralized. And there is also the removal of long tail assets, because most of the coins that are used, the liquidity is shared. So if one coin gets exploited, you might be able to exploit the whole system. So that's why they are more and more focusing on the most liquid cryptocurrencies, because that's less of a risk of manipulation of failing liquidations. Also, one big key issue is that currently it's super early because we don't have traditional financial assets. We don't have treasury bills, bonds, equities, what the traditional market is all about. That's mainly due to a regulatory hurdle. It's very difficult to get those products approved. And so currently we are quite in a circular economy where the only reason to use a crypto repo market is to get more leverage, which is not very helpful for the world economy. So let's go now on some innovative use of a crypto repo. So one key component of DeFi is composability. And when you launch something in DeFi, everyone can use it. You don't have to ask the permission. So other protocol will use your protocol and other protocol will use the two protocols and so on. So one example is in the slides of Raphaele on the liquidity pools on Uniswap. The two biggest ones are actually refinanced by repo. So the market makers or the liquidity provider are 50 times leveraged because they are refinancing their position. There is also other ways to leverage on the repo market. So it's quite used for that. And one key component that is in DeFi that isn't really in traditional finance is that we have what we call the flash loans. It's kind of a funding that need to be repaid at the end of the block, but you don't need to have collateral. Because if you cannot prepay at the end of the block, everything is canceled. So that's a way to build high leverage for a block or to create position. And you borrow, you buy your assets, and you deposit those assets as collateral, and you borrow against them to refinance the flash loan. We are also working on a DeFi/TradFi integration. So that's quite innovative as well. The Société Générale Forge started to borrow 7 million DAI against a AAA covered bonds at MakerDAO. So you can see it on chain. It's a native Euro Ethereum bond. You have the ISIN, and you can see on the picture on the bottom left that it was put in a maker vault. What we call the vault are kind of the pools where we store the collateral for 9.5 million euro collateral. And again, the picture on the right, as there was 7 million DAI borrowed. Currently, the collateral management is still done off-chain because MakerDAO and most DeFi protocols are not legal entities. So it's very difficult to have securities in the hands of something that doesn't exist. So it's quite convoluted, but still working. And the very interesting thing that we discussed, there was a discussion in the last call about accounting of the collateral. Well, here's the collateral, you can account for it. Everyone can see where is the collateral and what is happening. with the collateral. The last example is the use of treasury bills repo. So it's not done yet, but there is a new product that is currently launched, which is a wrapped version of treasury bills, or in this case, a very short-term treasury bond ETF. Due to the US regulation, it will only be allowed for people that are performing KYC AMM. You cannot send it to anyone. It's not permissionless, it's permissioned. But the overall key idea is to create a repo market where only people that are whitelisted can use this token, but anyone, even meaning permissionless, even persons that are not KYC AMM, can lend the cash. So that will allow people to leverage on this position. And as we know that the rate in DeFi are lower than the rate in TradFi, there is an arbitrage to be done here. So there is more than likely people will come to exploit this arbitrage. And that will, by consequences, increase the DeFi rate and reduce the gap that you can see between the rate in TradFi, let's say treasury bills, and the rate in DeFi, which is the RV repo or whatever repo market we have currently. So that's quite an interesting way to see how we will reduce the gap between those two rates. To conclude, the question, is it a new paradigm? I would say that DeFi lending is very close to TradFi. It grew independently, but actually we are kind of relearning some lessons that we could have learned by just doing the mistakes of TradFi before, like not doing repo on exotic assets that are illiquid. So there was a lot of, and FTX was kind of in this problem as well. But if you just look at the global financial crisis, well, those would be the illiquid CDOs and so on. In DeFi, the difference is that in DeFi, it's way more adversarial. It's transparent, immutable, and permissionless. That means that if there is what we call an highly profitable trading strategy, that is there, someone will exploit it. You cannot say, well, only good player will be in this market. Well, actually, anyone will be in this market. And even if you need capital, as you can use flash loans to get 1 billion of capital to execute a trade, it's not that difficult. Capital is not an issue. And that leads to the fact that DeFi is more innovative. Thanks to composability, you can leverage all the product. Most of the product are permissionless, so you can use them. And it's more open because you can see the code, you can see everything that is done. So that's foster innovation, and that enables the space to move way faster. And the last one is that DeFi is more transparent. Anyone can follow and research in real time the financial stability of the system. You have all the data. You can do the accounting as you want. Everyone can have his own accounting. So that's, to really conclude, I think for me at least, DeFi is kind of the shadow bond king, but in daylight, kind of as it should be to do it properly. And that was my presentation. Thank you very much.
Thank you very much, Sébastien. I'm thinking here, thinking back to hearing from Claudio Borio earlier, a strength of the money view that we've known for a long time is that it's a language which practitioners can use and understand, and that label applies to some of us. Some of us are also academics, and it's a language that we can use. And I think we've known that in many institutional contexts in the past, different moments in time, historical, institutional structures, even going way back to different technological times. Sébastien and Raphaele both, we can understand them as practitioners of different kinds and academics. And so I think it's interesting to see how the language of the money view goes a long way to creating a place where we can actually have deep and thoughtful conversations about what these things mean and what to do with them. And Larissa, also co-organizer of the session, we could call also maybe a practitioner in a somewhat different way. Larissa has a good vantage point from which to look at these issues, but as I'm sure she's about to say, she is here to speak to us of her own personal views. not those of her employer. But I'll hand it over to you, Larissa, to talk about institutional DeFi.
All right, thank you, Dan. So I'm Larissa de Lima. I'm a senior fellow at the Oliver Wyman Forum, which is a consultancy's think tank. I co-lead our Future of Money initiative, which works with financial institutions, innovators, and policymakers in thought leadership and events and digital assets. So while the forum works with organizations of all sizes, I'm going to be taking a very different perspective than Raphaele and Sébastien, because I'm going to be talking about what larger financial institutions are doing in the space. So I'm part of a team that worked with JP Morgan, DBS, and SBI to summarize the lessons from a pilot they ran with the support of the Monetary Authority of Singapore called Project Guardian. And as Dan said, the caveat, the report is publicly available. The views here are my own, and I am recovering from a cold, so apologies if I cough. And I'm also going to try to speak very quickly to make sure that I get to all the points I want to make. All right. So what I'm going to cover today is first, what is institutional DeFi, which is the concept that we introduced in the report. Second, why it matters with a little bit of a money view perspective, what's already happening in the space, and then finally going to talk more about Project Guardian, the pilot, and its lessons. All right, so what is institutional DeFi? So there are three important elements. The first is that it's real world assets getting tokenized, not crypto. So real world assets is really where the value is at. You're talking about a pie of nearly 500 trillion versus maybe 3 trillion cryptos past day. Tokenization is the process of representing those assets in shared mutualized ledgers. Then it's also about DeFi protocols, and it's protocols specifically, not all aspects of decentralized finance. Oh, sorry. Coming back. Not all aspects of decentralized finance, because we're not talking about decentralized governance. That would be a bit of an oxymoron, since we're talking about big centralized institutions playing in the space. And then the third element is appropriate safeguards, because again, we're talking about regulated financial institutions. And safeguards really matter. So why each of these three elements? So the first on tokenization. What is really unique about blockchain technology, which Raphaele and Sébastien have spoken to, is that you have this level of transparency because you have both record keeping and value transfer coexisting in the same network. So think messaging, clearing, settling, they can all coexist and co-evolve in the same network. And all of that information is transparent, and all of the information needed to clear, settle, and transfer is made available to all participants in the network. This means that you don't need intermediaries in the same way that you do today, because you don't need them to process the information needed to the transfer of assets. So this means that the hierarchy of information is flattened. Now, I said hierarchy of information, so this is different than the hierarchy of money, but to the extent that a hierarchy of information is important and a driver of creating a hierarchy of money, that's one of the forces that changes in the system. So we have this evolution from siloed networks with information distributed in the hands of intermediaries to a shared ledger that is viewable by all. All right, second element, DeFi protocols. So if tokenization is about mutualized information, DeFi protocols enable mutualized business logic. So you can replace distributed business processes at each individual intermediary with shared, connected, automated ones. So there's a lot to this image, but let's keep our focus just on the left-hand side. So you have the settlement layer. That's the ledger that enables record keeping and transfer of value in one place. You have an asset layer, which are the multiple types of assets that can be issued and transferred on those networks. And then protocols and smart contracts are the programs that enable this automated business logic. So they can come in the form of new financial products like automated market makers, as we talked in this panel, but it could also be things as simple as more efficient clearing mechanisms, smart netting of liquidity. So there's a lot, you can be as creative as you want. And as Sébastien mentioned, you then have composability to knit all of these different programs together. So why do financial institutions care about this? So the first, and I'm going to only go through a couple of these. The first I've already kind of previewed is that this could mean pretty significant gains for back office efficiencies. Huge operational efficiencies anytime you can vastly simplify a process because it requires multiple parties to come together. All of a sudden, that information exchange is much cleaner, and huge efficiencies, for example, for something like post-trade reconciliation. It can be fully automated. You can also have money moving quicker and cheaper. Now, as Raphaele mentioned, you may then have some, that raises some questions around like how liquidity is remunerated, but it opens the question of more efficient business models. And if you have all of these different assets coexisting in the same network, so think bonds, equities, cash settlement that exist today across several different exchanges, all in the same place, that can also mean have very different implications for how liquidity is pooled. So again, for a money view crowd, that's going to raise a ton of different questions, but makes for quite an exciting and potentially very different market structure than the one that we have today. So the third element are safeguards. A system that is trustless has its cost. People pay for it through over-collateralization. Alternatively, you may want to ensure participating players have thresholds of prudence, risk management, disclosures. There's mechanisms to resolve disputes. There are ways to introduce trust back into the system, and a ton of different considerations on the safeguard sides. I'm not going to go into it, but there's a lot here of concern that for regulated institutions would impact how they want to enter the space. All right. Institutional DeFi may seem like a very foreign concept, but we are already seeing the breadcrumbs and like the some early motion in this space. What we have observed is there's a ton of experiments with real-world asset tokenizations by financial institution. So there's the example that Sébastien mentioned between MakerDAO and StockGen, but these types of experiments are happening across asset classes. This page is very out of date and very simplified because the reality is like every week there's news from some new experiment being announced. Also, central banks are very active. Not on this page are the many experiments around tokenization and new networks for cross-border settlement, which we may hear more about in the next couple of days. But on this page are some of the efforts that are specific to DeFi. Some of them are like Project Guardian, which are about central banks working with financial institutions to see how they can safely be partaking in the space. But then you have an experiment like what the European Commission is putting forward, where they're actually thinking about how will DeFi, because of the transparency blockchain offers, fundamentally change supervision? And is there an actually different way that there could be automation of compliance, for example? So a ton of activity both on the regulated financial institution side as well as among central banks. All right, so now I'm going to talk a little bit more about Project Guardian. What was it? So it was a project launched by MAS, Monetary Authority of Singapore, in May, and they were very interested in exploring the DeFi space and what could be a regulated version of it. And they had 4 goals. The first was to explore open interoperable networks, and this meant exploring open permissionless blockchains, and this was to avoid fragmentation or that fragmentation that may emerge when you think about just private exchanges and markets. Second, they wanted to explore the operational feasibility of asset tokenization. Was it a dream or can it be a reality? Third, they wanted to do so in a way that was trusted. And as Sébastien mentioned, AML, KYC, huge concern. So they wanted to ensure that trading was only done by verified, trusted counterparties. And then finally, they wanted to ensure institutional grade protocols. And what that meant is that they wanted to mitigate the risk of market manipulation as well as operational risks due to cyber, et cetera. So pilot 1 took place from May to November and put those 4 objectives in action. So it was led by DBS, JP Morgan's Onyx team, and SBI Holdings, and there were two different work streams. One of them was looking at foreign exchange transactions, and they modified Aave, which is a lending protocol, and it was based on a tokenized deposit based on the Singapore dollar and a tokenized asset based on the Japanese yen. The second work stream was a modified automated market maker. It's a modification of Uniswap for trading of government bonds. And again, it was a Singaporean government bond, a Japanese government bond, also using Singapore dollar deposit and Japanese yen asset. Conclusion, yes, institutional DeFi is feasible. However, it is very early days and there needs to be a lot of work to ensure that it gains scale. This is how we list those different enablers in the paper, but I actually am going to restructure this and just focus on a few of the lessons with a bit more of a money view angle. Before I go into the lessons, I want to say we're very much in early days, and I know I said that there's a lot happening, but it's going to take years, if not decades, for there to actually be significant scale and full force revolution. So it's actually quite exciting to be now at the start and starting to think and observe how the system is evolving. The ways in which it develops and the ways in which it gains scale, if it does, it's going to have an impact on what new networks and markets emerge and how integrated or disintegrated they are. It's going to have an impact on market makers' ability to connect those different markets and what business models they have. And it's also going to have a role in determining who and how settlement happens across these different networks. So there's going to be a ton of decisions that are made in the coming years about the details of what is allowed to happen and what isn't. And that's going to drive the direction for one path versus another. Like innovation arrives, then there's like animal spirits, and then there's path dependence, money, liquidity, they have network effects. So all of these different lessons are just about like sprinkling a little bit of dust around how we might think about the evolution of the global financial system, just given these changes. So talking through the lessons, lesson one, for there to be scale, there needs to be industry-wide standards. Big political project, not an easy task. And this is really going to shape whether there's integration or fragmentation of markets. There's a ton of experiments, not a lot coming together. Everything's really TBD. And I haven't even begun to talk about all of the cross-border settlement projects that are going on. So how it all fits together, lots and lots of question marks. But then related to what markets emerge, you have to think about what market maker business models are going to emerge. So lesson two is that more refined business models are needed. So Raphaele opened up some questions around, is this automated market maker, are they sustainable? Are they profitable? How do we think about that? When you throw traditional financial institutions in the mix, and then you think about them issuing tokenized deposits, they may not require over collateralization. They may have like their own sophisticated credit modeling. Maybe there's a possibility of new and different models emerging, but lots of question marks around what those business models will look like. Second, helping define the profitability, or like what kinds of buffers market making may need. You have questions around from a legal perspective on how disputes are resolved. So let's say there's an operational issue midway through a transaction happening. Some part of the smart contract process fails. So who pays for it? Who's responsible? So the pilot resolved this with some bilateral agreements, but there's going to need to be multilateral agreements, legal certainty, and all that shebang. And then finally, the last two lessons are about settlement. First, you need to clarify whether on-chain settlement is settlement at all. So I had on my earlier slide that layer at the bottom saying settlement layer, but it's still an open question whether settling on-chain actually means settling from a legal perspective. For the pilot, they actually had to have all sorts of off-chain processes to ensure and satisfy the legal requirement around settlement. And when you think about that, that kind of negates some of the operational upside. Second, when you're talking about settling on an open permissionless blockchain, there's a cost, and that cost is generally paid in some crypto asset. However, banks cannot or have limitations in whether and how much and in what form they can hold crypto assets. So this either gets resolved by banks being allowed more flexibility in owning crypto assets, or perhaps some other intermediaries need to be the one that are resolving the settlement in that piece. And so those are some of the lessons. So we're running out of time. We haven't even gotten into what role central banks can play. So this is really meant just like as a teaser. Hopefully it's enough to feed some thinking around potential paths and what the impact of those paths might be. And if you're interested, read the report, I'll drop a link. And now I'm excited to hear more people's questions and discussion.
Awesome. Thank you so much, Larissa, and thank you to all three of our speakers, Raphaele, Sébastien, and Larissa, for sharing this. I really think it's quite remarkable to have this not just level of knowledge, which is already impressive on a difficult subject, but also three speakers who are genuinely curious, genuinely knowledgeable, and genuinely like interested in having a real and open conversation on this subject, and not, I don't think, any of the people who are speaking to us are trying to sell us anything, you know. So that's kind of remarkable, can be remarkable in conversations on this space. So with that in mind, we are inviting questions now from the audience, and if you can, I think what we have is to put them in the chat. That's a possibility. To raise your hand. That's a possibility, and I'm just asking, so I'm trying to collect a couple more, because I did ask at the beginning, and I would like to try to hold to this. If you could try to direct your question to more than one of the speakers, if possible, so that we can work towards having a little bit of interaction. And finally, I'll say, if I'm going to insist that you get to the point quickly with your question, and if you don't, I will gently prod you to get to it. But we're here to talk. So so let's see. I think we've got Matthew with your hand up, and maybe Chris, you put a question in the chat, but maybe you could just come in and speak that to us so that we can all hear. Matthew, go ahead first.
Yeah, thank you very much for those presentations. They were all outstanding and very well done. I didn't understand half of the stuff that was going on, but that's my own fault. My question has to do with the hierarchy of money, so it's more of an academic thing. And I just wanted to get the speakers' interpretation of where DeFi falls in the hierarchy of money, especially since to me it seems like it doesn't fit in the hierarchy very well, because when we look at the hierarchy, the base, as we go down more, the quantity increases, and I don't think the quantity of DeFi or the trade frequency of DeFi has really outpaced securities yet. So I just wanted to get people's opinion on how this sits with the hierarchy.
Thank you, Matthew. Chris, would you mind just speaking your question in the video channel here?
Yeah, sure. So the question I asked was about tokenization of real assets. And the question is, if a real asset gets tokenized, does it then belong to that system forever, or can it be de-tokenized and separated from the system again in future?
Thanks, Chris. And we'll do one more from Thibault.
Hi guys. Yeah, it's similar question with Chris Rimmer, but just to clarify it, I think when the asset is tokenized, we are talking about synthetic asset, right? Just if it's possible to argue on this.
Could you say that again? What was the last word? Just the key word from your question at the end there.
When we are talking about asset tokenization, do we talk about synthetic asset, like
synthetic assets? Yes.
Synthetic asset, yes, because yeah, well, as we saw with NFT, for example, with punks, on Ethereum, it's easy to duplicate asset between blockchain, private blockchain. So I think we do tokenized asset will be synthetic asset. It's just my point.
Awesome, thank you. So that's 3 questions. I think that's enough. I would say leaning a little bit on the technical side, which is fine for this conversation. Let's go around with these 3, and then we'll do another round. We have from Matthew a question about the hierarchy of money and where we might fit DeFi in. From Chris, a question on tokenized assets exiting and entering a sort of system of asset ownership, and from Thibault, a question on synthetic assets and where we fit those in here. Speakers, is anyone ready to go first?
Sure, maybe I can share my view and let the
Sébastien,
other see if they agree or disagree. So just on to start on the opposite, on the synthetic asset, that was a trend because it's easier. It's less to use those days. And if you look, for instance, in the case of the SocGen bond that is on-chain, the source of truth is on-chain. So I'm quite sure in all the legal documents, they can have a solution to extract it and put it in other blockchain or on paper. But in the document, it's clearly stated that it's on Ethereum, and the source of truth, it's really a native Ethereum bond. And to broaden on the untokenizing, usually what we call, so there are native bonds, for instance, for the SocGen one, we have wrapped stuff like you have real estate, you put it in an LLC, and the share of the LLC are represented on chain. So you can unwrap it by just doing the opposite. That could work, and that was done already in the days. And for the hierarchy of money, I would say it's an extension of hierarchy of money. You have some crypto banks. Let's say you can have the circles that don't have the elasticity because they need $1 of treasury bills to issue $1 of USDC. But you have other like MakerDAOs that, well, don't need to have dollars or reserves on the balance sheet, and they can expand the supply of money. So that's kind of an elasticity. But obviously, it's one layer below everything else, especially because they are, for instance, MakerDAO is depending on USDC, which is depending on the banks, which is depending on the Fed. So it's quite low, quite at the levels of the euro-dollar, if you want, on the hierarchy of money.
If I guess I'll add just 2 things on like the synthetic asset. I just underscore like the matter of legal uncertainty, and like that is one of like the key barriers for regulated entities partaking in this space, or even like one of the things that they're trying to experiment. And there's like some regimes like the DLT pilot regime in Europe that allows some flexibility and some experimentation, but that kind of necessitates, that kind of in some ways limits the ability to issue directly and have exclusively a digital native. So what we see many times is a lot of experiments that, you know, there's going to be a digitally native, but they also have like an off-chain issuance as well. So it's still, I think we're still a bit far away from not having a, you know, like dual existence for a bit. And then on the hierarchy of money, so I think back to the last Money View symposium. So Zoltan was talking about like one of the you know, refinements or extensions of like the Money View hierarchy is the fact that even when you're going to one level to another, some levels actually have like several different types of networks within them. When you have a repo rate, there's actually several different, there's like multiple repo markets because each repo market has like slightly different types of institutions involved. And one of the things that is kind of like put in play with this is like a flattening or like a conjoining of several different networks. So I think that to me is one of the things that might change, and I don't think it changes the fact that it's a hierarchy, but it kind of changes like the detail within like each of the levels.
Yeah, maybe if I can jump in, I guess you could have a hierarchical network I think with stablecoins, in a world where they're regulated and properly collateralized, we can think of stablecoins sort of parallel to currency, maybe above bank deposits, right? As if they're fully collateralized. And one could imagine kind of a credit extension of that in crypto that could be very low in the hierarchy, depending on collateral and things like that. And then central bank digital currencies could also be something else to think about as a new top of the pyramid in digital form. I think with Bitcoin is another interesting scenario of scarce digital commodity on potentially on top, maybe Bitcoin, kind of a digital gold. There's lots to say. It's not such a clear picture, at least for me in my head exactly. And part of it is because the system is rapidly evolving and still very early days, right? But I would think hierarchy of money is going to be very useful to think about the DeFi space as it evolves.
Thank you, everyone. We're doing pretty well on time. Right now, Karen has a hand raised, and I will hand the mic to Karen to get the next question. But if there are other questions, I have a million questions, so I'll make up some questions if we need to. But if you've got a question for these people, this is your best shot to ask it. But Karen, why don't you jump in first with your thought?
Thank you. This is all very technical, and I miss a little bit the overview of what all this means. When Bitcoin started, it was a way of getting around the regulatory system, as far as I'm aware. But here you seem to want to get the whole thing into a very regulated, transparent, etc., pattern. And this is, in my view, not what finance is about. So it's a way of trying to restrict finance, but at the same time, what you're talking about also features that will expand the financial system. So how do you sort of balance this out in your thinking that this system will expand? What are the risks? You haven't talked about the risks of all of this, and what are the relative magnitudes of these systems that you're talking about? Are they sort of all encompassing? Or I mean, what is sort of the future of this? I don't expect an answer, but I just would like to have a little bit of reflection on risks and how this sort of fits into the system as it is, and how it will evolve. Thank you.
Thank you, Karen. It's an excellent provocation, even if it's not quite a question that we can hope to answer in 4 minutes. It is a provocation that we might begin to think about. Assad Khan you have your hand up. Would you like to jump into the question?
Yeah, just kind of for the group, it was actually somewhat related to what Karen was saying. I wanted to ask the panelists if they there's a lot of discussion about crypto, DeFi, whatever it is, cannot fit into traditional models. I wanted to understand if you felt that was true, if there is significant fundamental differences that would require, let's say, a change in regulatory policy or approach. Rather than kind of what we've seen today, where everyone is trying to say that we can fit this into the existing boxes that we have today.
Thank you, Assad. Jay, you put a question in the chat. Do you want to take a minute and be a participant here for 1 second and ask a question?
Yeah, sure. Thanks, Dan. And thanks, everybody. I thought this conversation was really great. I see a lot of the benefits and potential that you're talking about, but especially with the shared space and putting things into the same network, as Larissa was saying. I was just have a very conceptual question, because I'm still trying to see exactly how sort of the elasticity element comes in, right? That we have from the banking system. And that was when I looked at Raphael's presentation, you had sort of a notion that there's sort of a loanable funds type operation that only the tokens are placed in or actually loanable, and there's no way to expand that pool. So this put actually huge limits on that market making capacity if we're actually trying to put it, as Larissa said, it to scale. So I'm wondering if we don't have to actually put banking into there at some point for it to actually be a scalable project. So I'm just wondering if that's correct based on what I heard.
Thank you. So we have questions from Karen, Assad, and Jay there. Panelists, anyone willing to jump in with some thoughts?
Saw Sébastien also muted myself. I'm happy to go first or second.
Go.
All right. Risks. There's so many. This is all like very early days. It's a lot of experimentation, and the way that policymakers have kind of, there's been some level of like, let's see what happens, in what ways the market can resolve its own issues, and then you kind of like, you don't want to regulate too early because you don't want to kill innovation. But that's also important because of scale. The scale today is it's quite small. But to kind of like tie in the first and second question, there's a ton of discussions happening at the FSB level with IOSCO around what kind of policy measures may be desirable. DeFi is a little bit harder than crypto, where there's been some convergence around like policy measures, just because there's a wider variety of views, with a few countries being like, well, we want to explore more of the potential with innovation, versus some being a little bit more conservative, favoring significantly more restrictions earlier on in the process. So what policy measures are most important? What policy measures are necessary? It's still a bit of an open question. There's a few different approaches. If that's something that you're interested in, I can link to a couple of different reports. But to highlight just one of the risks, because I was talking about like this market integration as something great and exciting and wonderful. However, the downside is that that increases contagion risk. When you have problems, it increases the scale of your problems potentially. There's a ton of like operational risks that become more salient, because if you become more reliant in one network. So lists are quite extensive. And then to answer Jay, I have like one more straightforward and one more speculative response to that. I think the more straightforward, if traditional financial players are to come into it, they are also looking to tokenize deposits. So there will still be expansion of elasticity on their own balance sheets. So that's one way. Is like one of the experiments in the pilot was using tokenized deposits as one of the sides of the token. The other more speculative answer is that you can imagine a future where there's more on-chain banks. And already with like Dodd-Frank, there was this movement towards like better fund transfer pricing, and having a fund transfer pricing that is more plays a bigger role in like the management of your bank. And you can imagine that fund transfer pricing is actually, should it be discretionary or should it be market-based? And what it might be for like on-chain banks with a market-based fund transfer pricing. That's a bit of a wilder idea.
Yeah, I will just add two points. First, that DeFi is quite orthogonal to cryptocurrencies, like Bitcoin, ETH, and so on. We can build a DeFi systems that use those cryptocurrency, or none at all. It will be exactly the same principle. And I don't know if in the future we will use the dollars through tokenized bank deposit or through stablecoin in the system, and bonds and stuff built on the dollars, or just derivatives on ETH or Bitcoin. And it's the same for me. It doesn't make much of a difference. And on the other side, on the expansion of money, I'm working for a protocol MakerDAO, which is similar to a bank, and we can issue the stablecoin as much as we want, just like a bank, but up to some limits, obviously. And for instance, we are financing most of the liquidity on Uniswap, because the two biggest pools we provide funding on those. And it's not costing much for us, because we are doing the same on some repo markets. And it's not costing that much of capital on our side, because we are providing a token that is not used. It's only collateral. As long as the collateral is sitting in a smart contract, it doesn't have any implication. It's just an off-balance sheet item. Obviously, it's never good to have a big off-balance sheet book but still it's kind of work so far. So we can expand the supply of money quite easily and provide liquidity up to a certain point quite easily. But that's an unresearched topic, so no one knows what are the limits and what are the implications.
And Raphaele, you get the last word.
Sure. Jay and Assad and Chris, I guess everybody's asking about leverage and how to think about the liquidity pool. Yeah, so I think for me, AMM is like an order book. It's a way of enabling the trades to happen. If you think about the market maker in a more holistic way, including the dealer, you would have to include the liquidity providers. And I suppose they could be leveraged. So, the debt could be on the balance sheet of LPs. And it's, yeah, I mean, so there could be dealer leverage. So I tend to agree also with Assad. The big advantage, I think, of liquidity pools is the deterministic nature of the price for liquidity takers, for traders, right? Like they don't have to worry about posting a limit order and then being picked off by a dealer that knows more than they do, right? The pool is very neutral, so that's the advantage. But in terms of the market making, it's more complex, and you'd have to look at the LP layer. The one big difference, though, is anybody can be an LP, right? As opposed to not anybody can be a dealer. You do need to have access to information in order to be a dealer and have a bid ask that makes sense, right? So there's a claim to democratizing access, but I think that this data on differences across LPs and the flash LPs potentially being profitable and the other LPs potentially not, maybe cast doubt on this claim. Yeah.
Awesome. Thank you for thoughtful responses to all of these questions and for great presentations. We're past our time, so we should draw the conversation to an end for now here. Thank you to all of our participants. People have shared, the speakers have shared links and things like that to their slides in the chat. You can find that. They're easy to find online. All three of our speakers are. So I'm sure that these are all conversations that these folks are willing to continue. And obviously this forum, the YSI Money View Symposium, is one of the best places for that. And often this breaks into smaller groups in the months that follow, all of which would be helpful in resolving some of these very big questions, which are here with us, it seems, to stay for a while. So thank you again to Raphaele and to Sébastien and to Larissa. Thank you all of you for your questions and attention. And why don't we stop the recording there?